Good evening, everyone. My name is Janvi Ajkalkar, and just before we begin with the call, from behalf of my company, Samco Mutual Fund, I would like to thank each and every one of you guys who are attending the call and have removed some time from your schedule. Um, just so as we're beginning with the call today, we're going to discuss about the hidden engine which drive and help to drive the changes into the interest rates, and how one can look upon it as when it comes to investments. And we have no better person than the gentleman, Mr. Umeshkumar Mehta, who is the Chief Investment Officer of Samco Mutual Fund. He's had a market experience of 25 years. He's understood the turmoils, just not on the technical level, but as well as emotional level as well. So he's an MBA and a CA. So without taking any further time, over to you, Umesh, sir.
Thank you, and a very warm welcome and good afternoon to each and every one of you. Today, RBI had a meeting, and surprisingly, so the word everyone used was surprised, that there was a pause in interest rate. So yesterday we had this meeting in English, in Hindi, and we showed some very powerful data, so that people could see that how Fed works, what is the real, why they drive, what drives changes in their mentality, interest rate, etc. I think that's how we are going to, that is what we are going to analyze in detail. It's not run on the mill that because inflation is down, interest rates are up, down. There is something more to it, what goes in that decision-making process, and that is what we are going to see today. So let's begin, and hope this will be very, very insightful for you all, and we'll be able to share something more and add value to every one of you. So let's begin. Is my screen visible? Okay. So this comes with the standard disclaimer: mutual fund investments are subject to market risk. So now let's begin. So the laws of economics. Laws of economics says that when prices fall, demand rises, and when prices rise, demand falls. And somewhere there is an equilibrium. So this is what rational mind thinks. This is what we have been taught. This is what the rationality is. So now let's understand further. So this is economic market, rational market. People see and buy things and goods. So this is price trend of personal computers. As prices of personal computers fall, the demand over a period of time has increased a lot. So this is what has happened in America and is also applicable across utility, across business, across markets that we see in India, everywhere else. As prices of goods rise, demand falls, and as prices fall, demand rises. So for example, petrol, today petrol is at 105, 107, assuming the price falls to 50 rupees. There will be so many people out there on the roads because the prices of petrol has fallen, the demand will rise. And this is how normal economic market works. This is what the rational thinking is. And this is how markets are behaving. Same thing again in India, as the price of data reduces, the consumption also increases exponentially. And this is applicable everywhere. So now let's have a poll. If stock prices are down by 40%, how many of you will buy? So whether you consider stock prices as a portfolio of stocks or it's an index, it's up to you. But if prices are down by 40%, so there is a poll screen that is flashed. Use yes, no, whatever you think is appropriate. And I give you half a minute to fill up that poll, and then we'll share the result, and then we will begin. So quickly, if you all can complete, we can go forward. So has everyone voted? Yeah, quickly, next 10 seconds, and then we are up for results. So when prices of stocks correct fall by 40%, will we buy? I think that's what, yeah. So if you can show the results, 86%, 86% of people have voted yes. And this is what, and yesterday also, when we had this in Hindi, actually 86% was the exact percentage. The number of participants were more, but 86% is fixed. So I think somehow there is magic in this number. But yes, this is what the rational thinking mind does, and this is what we see out there in the market. But in finance, it's absolutely different. Here, as prices rise, investor demands more. And when prices fall, investors don't demand. And this is what here comes the major difference. So this is financial market, and this data is from US market. As the prices of S&P 500 was increasing from 1990s to 2000, the biggest bull market that we have seen, the number of US stock owners doubled. Number of US stock owners doubled, and from 52 million to they have increased by around 80 million. So this is what we have seen in America. If prices are rising, people think I want to own stocks, and I have missed out this rally. And this phenomena is unique to financial market compared to the utilitarian market or compared to the rational economic market that we go out and see. Again, volume. So this is 70 years old data. As S&P 500 index was rising, the volumes on NYSE was also rising. As prices rise, demand also rise. India also 2008, 2007 at greatest bull market top. It was only in last few months that the volume had almost doubled. And prior to that massive secular bull market, the volumes were normal, but it was only at the top that volume had doubled. So this is what the reality is. Now, answer is, so why this happens? So I give you a minute or so to write on the chat box why you think that there is this divergent view or this different view. Personality is one, the human being is the same, but he acts differently on when he comes to taking rational decisions, economic decisions, when he goes out and buy things. But when it comes to finance, stocks, bonds, interest rates, yields, etc., his reaction is absolutely different. Why this? If you take a minute off and if you can write down on the chat box, it will be of great help, and then I will come to the reason why. Behavioral biases, some people are writing, price increases, the people think that there is bright prospects for that script or a stock because of fear, greed and fear, herd mentality. People are making money, so everyone wants to buy, vice versa, greed. So this is what, and actually this is correct. What you have written is what herd mentality. This is what people think, and this is why people are behaving like this. Correct. So almost everyone is in the thought process. Fall is too severe, uncertainty may result into further fall, so better not to buy, etc., etc. Thanks. So I think let's stop and let's understand the reason why. So let's get to the core of this. An understanding of this is very important for every one of us to know why we differ or why our behavior is different from rational or economic thinking to one that is in financial market. And this is the reason. So our mind. So when we go out to buy things rationally, utilitarian, for example, a shirt or things that we buy, we think from this outer cortex. So the blue color mark that you have seen, and this is all about rational thinking. 1,000 rupees shirt, if it is available at 700 rupees, I think 30% is a great discount. Probably we'll go and buy, because there are reference points, and because we know we know the value, or we know the utility, that probably given the cost it is. So given the car what it is, if the 10 lakh rupee car is available at probably 6 lakh rupee a discount, we know that we will buy more. But when it comes to finance, so the writer side, if you see, this is where we decide when it comes to finance market, and here the decisions are emotional. So why this? And this point is very important in finance. So for that matter, stock. A stock is just a piece of paper, a 1 share or 10 share or 100 share. So people don't know what is the value of that stock. So because they don't know what is the true value of that stock, majority of people don't know, what they do is they go and understand what majority are doing. If everyone is buying, there is something right that everyone is buying, and therefore let me also buy. So this is where they get the reference points from. The reference point is the crowd. If everyone is buying, they also get that reference point that, okay, let me buy. But on that left side, on 1,000, I know that a value cost of a shirt could be around $1,000. And if it is available at 600, 700 rupees, it's a discount of 30-40%. Let me go and buy. But over here, there in finance, because there is wide valuation, there is wide fluctuations in the perceived value. And that's the why, and that is the reason why people go towards safer option. What's the safer option? If everyone is buying, let me buy, I'm on the safer side. They don't want to go against the crowd. And this actually is, we draw from our thousands of years of DNA that we have formed when we were hunter-gatherers, and when there was fear, we don't know. We all, flock together, we all run together, or we all act together. And that mentality of acting together is still prevalent in finance market, because finance, there is a lot of uncertainty. The price of Reliance is X. The price of Reliance could be X plus something or X minus something. People don't know, and therefore they flock towards herd crowd, and that is what we are saying. So this is the main crux, the difference between utilitarian economics and finance. Finance, as prices rise, demand rises. As prices fall, demand falls. And this is applicable everywhere, whether it is bond market, equity market, derivative, exotic, all asset classes, wherein people can't see an asset class. When people can't see an asset class, the value is in perception, and perception changes, and people don't know what's the real value, and therefore they they take a safer option. Let's go with the crowd. So this is a proof. So this is US market. So there they have these people there are agencies who measure the sentiment of investors. So in 2009, the market bottom, only 2% of the people were bullish. And I think that's the biggest thing, when markets were down by 45, 50%, it is a great time to buy. Out there on utilitarian economics, if the short is available, 1,000 rupees short is available at 500 rupees, it's a great time to buy. But over here in finance, because prices are down by 50%, entire crowd people follow crowd, and they don't want to apply their mind. They are fearful, and therefore only 2% of the people were bullish. And at the top, 90% of the people were bullish, and that's how this finance market works. And this is the reality. This is how our mind is configured to think that way. Our emotions, our greed, our fear comes from that little part in our mind, because they don't know the real value, and therefore they shift towards crowd. So now next question. This also you can write on the chat box, yes or no. Are central bankers herding? My question is, are central bankers also hurting, or they are so intelligent, they do their economics, they do all those data crunching, analysis, and take decision, or they too are just like any other investors, they hurt. A good number of people have said yes, no, good. I think, yeah. So now, if I can permit to take a pause and let's, yes, no, yeah. So, yeah. So the answer is in my next slide. Are central bankers hurting? Answer is yes. Why? See, because interest rate also for them, there is, what is a reference point? You know, where can they get references? The reference is because interest rate per se, as that it's just like a stock value. You know, how do we get the value? Whether the stock price is 100 rupees, 50 rupees, or 120 rupees. So basically, that value is derived from crowd. So similarly, central bankers also, where do they get this reference from? And they get reference from market. And this is what we say central bankers also hurt. So let me give you the proof of this. So this is very important, and you can watch this. This is a US Fed from 2017 till mid-19. If you see red line is the Fed rate. And if you see the black and the orange line, that is 3 months, 6 months treasury bond yield. So this is what we call as the market. So the point that we are driving is Fed follows the market. Fed herds. They also follow the crowd. So now let's see the proof of it. Over here, when market started, the yield started to rise, Fed responded by increasing the interest rate. Again, when the market started to rise, the yield started to rise, Fed came up and increased the rate. Again, when markets was rising, Fed came up and increased the rate. Again, when market was rising, it came up, increased the rate. Market was rising, Fed came up and increased the rate. So my next question, from now onwards, will Fed increase the interest rate or will it reduce? The answer is yes, it will reduce because the market rates are falling. The yields are falling. Fed also will follow. And you know, post 2019 and early part of 2020, the rates were next to below 1%. And this is what, because markets were falling, yields were falling, Fed also followed the market and they reduced the interest rate. So let's now look at the current. As on yesterday, we are showing you this picture, how the Fed has responded. But before that, let's understand what was Fed saying about in December 2021. So Fed shifts to inflation battle, winding down pandemic support, and the commentary of that Fed was they did not increase the interest rate, but what they said was 3 possible rate hikes next year of 0.25%. So 0.75% was the estimate for their full 2022. And you know what? 2022, there were so many hikes, and one hike was two hikes was 0.75%. So this was what Fed was thinking back in 2021. So now let's see, this is the most important slide of today's presentation. So now let's understand. So this is where the December was. I was referring the headline in New York Times. So the Fed rate was next to 0, but market rate, this is a 2-year bond yield, but market's yield were started to rise and market were expecting that interest rate will rise. But Fed was still in denial mode. They tried to justify. They said, yeah, we may increase. Inflation may not be a worry. But over here, when market massively increased the real expectation interest rate, Fed came up and they quickly increased the interest rate. See, the gap then got reduced. Why the gap? The higher the gap was there, Fed had to quickly increase the interest rate. If the gap was lower, they would have done lower. Over here, if I come back for a minute and say, see, by early 2022, all the pandemic money, 2020, the Fed had printed so much of currency, so much of free check that they had given helicopter money to American citizens. They, in their wisdom, they ought to know that inflation is going to rise and they need to increase interest rate. Why they have to wait for the market? So this is the proof in the pudding that see, Fed also follows the market, because only when market started to inch higher, Fed started to react. Otherwise, they were in a denial mode and they said that inflation will not happen and we will keep the interest rate where it is. Slowly and steadily, they changed the trajectory. And then when market started to rise rapidly, they incrementally increased the interest rate and 0.75 bits. So now let's come over here. This is the crux. Now, market rates are lower and Fed is sitting here. So my next question, will Fed increase the interest rate? Answer is no. Because market has given a clear signal, it's enough. Because it's enough, Fed will soon get reason, whatever it is, and they will then take a pause and then steadily lower the rate. And actually, honestly, this is what even RBI people say surprise. It is not a surprise. If we see how central bankers have behaved in the past, and rates currently are short-term, long-term rates are below short-term rates, this is a clear signal that pivot is going to happen. Pivot has happened. Interest rate peaks have already occurred. And from here onwards, markets are going to price in lower yields. And this is what, and this is what even today's pause that we have seen. But actually, this is not a pause. This is a peak. Interest rates from here onwards are going to fall. If not fast, steadily. We are not saying that interest rate will quickly fall, but this is a pause and steadily the trend is downwards. And this is what is the crux. And when this happens, a great moment for equity investor, this becomes a very, very insightful period. And why? So we have done this research on 50 years of US market and around 22 years of Indian markets. And let me share that result as well. So this is what we have done in Indian market. Whenever RBI has pivoted and then slowly interest rates have fallen, investor does an SIP for 3-year period. And when he holds these assets for 5 years, he has always made positive return, and positive returns in high teens. So here is the crux. There are so many periods of time when investors does SIP and he says that I have not made any return in 3-5 year period. But what we are saying is, in current juncture, in interest rate pivoting, and when interest rate peak is near or behind us, and when he starts doing SIP in this period with a 3-year horizon, 3 to 5 year horizon, he will make money. And we check this in American market as well. US also, it was the same thing. From 1970s, whenever the pivot happened in Fed, an investor invested with a 3-year vision with a 5-year investment horizon. In US also, they have made positive returns. So this is what we are saying, that these are very, very interesting times. And these are consolidation, because markets are not going to crack more. If markets are not going to crack more, the sentiments will take time. And this is time to accumulate investors, to accumulate units at this level. And when bull market emerges, that's the time when he will see a bright return in his balance sheet, in his P&L. And that's why we see that this 2-3 years is an accumulation period. He should accumulate aggressively with a 5-year horizon. So now next question will come. It is likely that America might enter into recession because the interest rate increase was far higher. So let us debunk that myth as well. As I told you, stock market leads GDP. So now let's understand this period wherein the market had already fallen, but the GDP, the recession is when there is a degrowth in GDP. That quarter, the first time GDP showed degrowth was at or near the bottom. Because market is a leading indicator, market had already fallen, saying that there is recession coming around the corner, and therefore the prices had already corrected. Same year, the next example, point number 2, here also market had fallen earlier, and then the GDP number became red. Over here again in mid 70 in 75s, market had corrected and the number had become red on the GDP. Same over here. Again, sometimes in 1987, in 85s, there was this recession, but market had already fallen over here in anticipation of recession, but the actual bad number, the GDP number degrowth came only when the market had already discounted. So around 15-18 months is the time lag. Market already preempts recession, and over here also in 2000, market had already corrected, but the number slight red flag in the GDP only came after the market had already fallen, and over here. So this is what we are saying, that these are very interesting times. The fear that markets are going to, recession is going to come. So that already in US stock market, for that matter, the world over already discounts that. Prices have already corrected. Sentiments are already poor. Redemptions are already happening. SIPs have already been stopped. Though weak hands are already out of the market. Therefore, we think that these are the times to invest aggressively and not be fearful. So this piece of data came just 2 days back in Economic Times, and this is very important number. Net direct tax collection, net of refund, is up by 18%. So if India as a whole, if direct tax collection increases by 18%, and if stock market is where it was a year ago, there is an 18% margin of safety for current for the market. Because if the pool of money, if the people have made more money in FY 22-23 and paid more taxes, that means that profitability, or for that matter, economy has grown by 18%. But market is there and there only. So this 18% buffer has been created, and going forward, this will get reflected in a higher jump in the stock price. And this is global IPO update. So global IPO market revival undermined by banking. So this is last year. Last year, 70% year-on-year decline in IPO that was visible worldwide. And America had the steepest fall in IPO collection. So my friends, it's a reverse of when bull market peaks, when there is euphoria, there are a lot of IPOs every day, every week there are IPOs. But during bear market, the IPOs are dry. The sentiment is weak. The merchant banker advises, please don't raise money. You will be whacked. People will not give you money. So these are true extremes. And today we are on the lower end of extreme, because people are not interested worldwide, not only in India. India also, we have seen IPOs are missing in the market currently, but world over this trend is, and therefore we think that secular bull market, the launching pad for secular bull market is intact, has already been there, and the Fed will pivot sometimes. In their next monthly meeting, RBI has taken a pause. Actually, it's not a pause. Most likely it is a peak. And this is where we think that markets are going to change, because no one is going to tell when markets are at lower level that this is the time to buy. People want comfort. People want to see things better. But that's the time market might have already run up higher. So now is the time to tell our investors that, look, now if you have money, if you have that wherewithal, invest in lump sum. If not lump sum, stagger your investment, increase your SIP, step up your SIP and invest, because now is the time to invest aggressively in the market. So this was this article some a week or so back in Mint. This is what the mood of the market is globally. India also in February 2023, 1 month ago, if you see this zero IPOs in July 2022, in July 2022 was the bottom, if you all know. June, July was the bottom, and Jan, Feb, March, again, this number is zero. So India also, the sentiments are same. They are weak. People are shouting about recession coming, or for that matter, high interest rate, inflation. But all those things are behind. Market has already discounted, and probably bear market is there in the minds of people. But in reality, things have changed. Markets are turning. it's time to investor press the button, pull the trigger, and put the investor's money, because year onwards, when he invests, he will see that high alpha in his portfolio. And this is the last slide. See, if you see emerging market, and this is what aggregate Asia, we as Asian countries, because the demographics are similar. In January 2021, over here, market had peaked. And that fear that recession might come in, high interest rate, everything was there in the mind. It has taken 18 months. Somewhere in June, July last year, market has made a bottom. So generally, statistically speaking, at 18 months, 15, 18, 20 months is a good enough period for markets to correct recession and interest rate cycle. And these are changing times. And markets worldwide has already given a bounce, rally. India is also rally, but people are still thinking that it might fall. Answer is no. It can consolidate, it can correct, but these are accumulation periods. Soon the markets are going to move higher and higher, and people will not be able to buy. They will still think that fundamentals, or for that matter, are still weaker, and they will keep on dragging. They will keep on postponing. But at the end, again, they will have FOMO. Oh my God, I did not buy. Let me now buy. So this keeps on happening in finance market, because they are herding. They buy reference point because prices are low. They think that no, it is not time to buy. But when prices are low, it's time to buy. When we think that markets cycle have bottom, interest rate cycles are peaking. These are the time to go hungo and invest aggressively. IPO market is dry. Global sentiments are weak, and this is the time when 18-20 months of already correction has already happened, and now the time for the investors to accumulate. So this is what we are driving, that investors should invest. If he's an aggressive investor, I think lump sum is a great way. He can stagger his investment in 3-6 months. For otherwise, all good number of investors, investing aggressively in SIP from a 3-year perspective is a great time. Step up SIP is a great time, but they have to remain invested. I think remaining invested in equities is key to seeing returns from 3 to 5 year perspective. High alpha return is important. So yeah, this was what I wanted to present. So I'm open to questions. You can write down the questions on the chat box, and I'll be happy to take all of them. So we had this yesterday in Hindi. So today it's in English. So just to clarify, we had these 2 sessions. So we have already done, so there is one thing, someone has asked that you should do this in Hindi. So we did yesterday in Hindi, and today it was in English. Next 5 years, what's your view on IT sector? And IT sector has bottomed out. If you see the layoffs and all those, see companies, the stock prices have already bottomed out some 2-3 months ago. Now the resultant actions are being felt, the layoffs and all those things. So we think that, I think that is behind. Markets are rising, rallying. All those fears should not draw down. And actually, when there is crisis, that's the time to go and invest aggressively. So IT as a sector has corrected a lot. And I think now IT is far more promising than any other sector, only if sector is to be considered. What about FMCG? So I think FMCG also will give a steady state growth, but not that growth that what IT is going to deliver in next 2-3 years. Market, especially service sector, what will be the cap, better, aggressive investor, large, mid? So actually, it all depends. So if investor is aggressive in a sense that if he's ready to say take a little bit more volatility. So I think ELSS as a product has a 3-year lock-in, which is suited for a mid and small cap portfolio. That is a better option. Otherwise, for others, flexi cap is a great option for investors with a 3-year horizon to invest, to get that high alpha return. Would pharma not be better than IT? Actually, it's pharma, IT, everything will move. Pharma is also beaten down, but pharma will have little bit more challenges because the demand, unless something really this thing like previous pandemic happens, the incremental demand has normalized. So if incremental demand has normalized, so this price correction will lead to returns, but abnormal returns are unlikely. So we will get market return in pharma as well, but not the above market returns. How do you suggest between debt, equity, forecast of performance in banking sector? So I think banking sector, finance sector is ripe in next 5 years. I think finance will also be as promising as they will give market return, but slightly better than market return. But yeah, I think banking and finance will deliver. Arrange some offline learnings. Yeah, so we have training programs, and one of the training programs we have in one of the lead IIMs. So we can be in touch with our partners, our distributors. In fact, our team, they will guide you in terms of what all trainings that we have, and one that is upcoming in IIM. Peak inflation environment, banking and finance sector is better. Yeah, so actually banking sector as a whole, the balance sheets are stronger, capital, they are well capitalized, 2-3 year credit growth is at 15%. So banks are going to do well, NBFCs are going to do well. So entire sector in terms of lending is going to do well from a 3 to 5 year perspective. So ELSS portfolio, I think we have created a great portfolio of mid and small cap companies, and we have deployed some 60% plus, and now we are aggressively deploying more. They all are high quality companies and have the potential to deliver returns. When bull market emerges, and this is what the seeds of the bull market are, and then our portfolio will deliver fantastic return. So which theme will provide better growth or value? So going forward, growth will deliver, growth should perform well, because last 1.5 year growth was beaten down because of high interest rate, but now that is reversing. I have shown you. So from now onwards, incremental money will flow to growth, and value had already moved higher. So the valuation gap had already reduced. But now going forward, I think growth will get a better priority, better opportunity. They will deliver far better than the rest of the market. Nifty index fund, how will chemicals perform? So chemicals have had a great run. So now they are in consolidation and correcting mode. Some of them will really again come back, move back. But some of them could be just China on the back of COVID, China restriction, logistics policy, logistical issues they made. Currently, chemical sector is in a little dicey phase. We have to really think and dissect which are secular companies which will still keep on compounding, and one which were just one cigar puff. Because of COVID, they got an advantage. Because of China lockdown, they got a little more advantage. So we will have to see properly which companies have the potential to run the cash generating engine. Then there is a question, which cap better, aggressive for investor, large, mid or small? With a 2-year perspective, if you want to say that which cap is better, I think then from a 3-year perspective, then I think ELSS is a good perspective, because there is a by default lock-in period, and mid and small cap will be better. But from a 2-year perspective, 1-year, 2-year perspective, then probably flexi cap is better, because there, because the market corrections have already happened, there is enough margin of safety on all our stocks. As market rises, he will be able to see numbers very quickly rather than getting into a lock-in period. So I hope we had sent this unit holders letter, our annual unit holder letter to everyone. If you can read through those initial 5-6 pages, and that will also give you a great insight, as to our funds, our performance. In fact, even the greater, why indexes were formed at the very first stage. What was the utility of that, and where utility has gone today. That will be I promise you, it will be a great insight for you all to read that. And that is not run on the mill letter that we have written. So we have sent this last month only. My request would be that if you can take time, please read that 10-pager letter. It will add a lot of value to everyone. As beginner, in which asset class can we invest? So this is one question. As beginner, so let me define. Beginner means a person who is investing for the first time. If a person is investing for the first time, and if he's young enough for the first time, I'm sure he is young enough, because by the time. So for a young guy, something like FlexiCap or something, equity fund only is his first option. And given where we are currently, the market structure where it is, for him, I think that once he knows that, okay, I have made fantastic returns in next from a 2-3 year perspective, we will always be hooked to investing. He will always have that inclination to save. And it is better for him that if he knows that if he saves, he will make money. He will invest. When he invests, he will make money. So yeah, equity is a good option to begin with, and FlexiCap is a good category to begin, because there it's all about it is market cap agnostic, and it gives a better proposition to the neophyte investor. Yeah, for the first time guy, FlexiCap would be a good way to begin with. So yeah, if we have more questions, we are here, or else then we can wind up. I hope it was very good. And we had talked nothing about inflation. We have talked nothing about crude oil prices. We have shared that, look, this is how markets have behaved, and this is what we think interest rate is all about. And this is how the change in stance is going to benefit 30-40 years of US market data analysis, Indian market. And these are really good times, when interest rate changes happen. There are winds of changes. There are a lot of commotion. People are not clear. People are confused. We thought, let's give them conviction, and so that they can also translate this conviction to their own investor. The investor also holds on, and they also realizes that, look, these are great times to invest in equity. See, El Nino effect and all these things, mid-monsoon could be little lower. But for a farmer, if I'm a farmer and I hold a land, if for 1 year also, if the monsoon does not come, I'm not going to sell my land, because, okay, next year will happen. So for that matter, bad monsoons, there could be short-term sentiment impact, but longer term, still markets have done what they want. And as investors, we should not be worried whether or not monsoon will happen, will not happen. That's a worry for, in fact, politicians to tackle that. But anyway, there could be a slight sentimental effect, but nothing to worry about from an investing perspective. How do you see small cap, mid cap index performing over 3 years? I think they will perform slightly better than the large caps from a 2 to 3 year perspective. Yeah, we have to give time to market, remain invested. Yeah, all those things are there. We have to, and last year was really bad, in a sense that, as I shown you my last slide, all across markets were down, and therefore everything was down. So funds like us did not get a chance to show what the players are, and we all had growth bias. So now is a time when our portfolio will show the true color. wherein we have a strong quality and growth bias, and as interest rate falls, we will have a higher jump in our values and stock prices. Flexi cap should be better because multi-cap, there are percentages fixed 25, 25, 25. But flexi cap as such, there is flexibility. So instead of fixating that we need to put 25% in large cap, 25% in mid cap, and 25% in small cap. So that is what multi-cap is. So I think that may not be advisable from investors' perspective, because why to fix? If there is opportunity in mid cap, let all money be invested in mid cap. If there is good opportunity in large cap, let all money be invested in large cap for a larger proportion, rather than fixating a 25% cap. So with that perspective, I think the agility should be there. And therefore, multi-cap restricts that agility, and therefore 25 may not be that good proposition for investors. Okay, so Janvi.
Yes, sir. Thank you. Thank you so much, Umesh, sir. It was your whole presentation was very insightful. And I'm sure many of us who had the doubts and questions about the interest rate and how one can accentuate their returns through SIP, especially during pivot of the interest rate is happening, is clarified. So thank you so much, as well as thank you for all the participants who have joined in on the behalf of me and my company, Samco Mutual Fund. See you guys soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.